3, 2, 1. Good morning, traders and investors around the world. Welcome to this Thursday edition of Pre-Market Prep with StockOdds. Sorry about the late start here and a little personal for fast market. But we're down. We're down 22 handles at 84 and a quarter. That's the bad news. We're off to pre-market low at 67.75. Bulls are defending it as we speak. The intraday low at 72. The buck doesn't stop here. Dollar index futures up 65 cents at 110.99. TLT down 275 at 105 and a quarter. New lows of the move. Crude, that's up 81 cents at 83.75. Gold, that's up 710, 1982.80. Silver in the green by 11.5 cents at 1959. And your cryptos, they're in the red. Bitcoin under 19K, down $45 at 18,935. And don't look now, the leader of the pack, Ethereum futures, making a new low for the recent move by a wide margin. They're down $45 at $12.75.50. We got Josh Smith in the house and also Dan back. I am going to stop the screen share. And the day after the Fed, Rob, tell us, stat me.
Hey, we should do that. We should do a bet here whether does Bitcoin go to 10,000 before 30,000. I think that's a kind of a
what do you want to do? What do you want to do?
We'll do it. You and I will do a side wager on that.
What do you want to do?
On the same side.
We're on the same side.
We might be on the same side. Okay. No, anyway. So this concept here of follow the Fed is been something that's been long standing, right? Now we know the Fed has lagging indicators that it looks at and makes decisions about policy, but the problem is they still control so much of monetary, stimulus, or they control, the tightening phase or whatever they do. But we've been in this age of sort of infinite moral hazard for a long time, and they're trying to unwind that to fight inflation. But what do we know? In previous cycles, where things have been problematic, it's taken a lot of years to kind of work out of it, right? This isn't like a quick fix. We've been kind of accustomed to, hey, you've got a problem with your laundry. Well, here's the solution. 60 seconds later, you've got clean clothes. You've got a problem with your abs. Well, here's a new machine you can hook up to your abs, and overnight you'll have fantastic abs. We're so accustomed to quick fixes, but in this situation, it's going to take a while to work itself out, right? Plus, we still have more rate hikes to come. So October, there's no Fed meeting, but in November there is, and it might be 50 basis points. December might be 50 or 25 even, but there's still more to come. And TLT, like you pointed out, the bonds have to factor in, some more hikes down the road, and this may extend into 2023 with even additional hikes. So we may go past the original target and be at a much more elevated level with rates. So that will cause some problems that don't get fixed overnight, right? So as we move into global recession concerns, again, there's a lot of contributing factors. And I think what I wanted to point out today is how important it is to understand how to sell the rallies. There's a more cynical nature that needs to be adopted by traders, especially if you've tended to be constantly optimistic, constantly bullish. You have to move into all of the factors globally that are contributing to, downward pressure. So I see, from my perch, I see the selling of rallies, right? And I think that's something to continue. So let's share the screen here. I'm just going to go to, I'm going to use the Russell as an example because I want to point out something on our Russell 20 list today. But here's yesterday. So we opened with a slight premium on IWM. It immediately dropped to fill the gap very, very, right, like literally right to the previous close. So it was a quick little gap fill, bounced again and stayed elevated right up to the F1C announcement, which is this. You saw that knee-jerk reaction. We've talked about it on the show before, that when the announcement is made, there can often be a knee-jerk move that can create volatility. And we saw that reciprocated in the sense of dropped and then rallied right to a new high. But look what happened afterwards. They started to sell that premium that was there, and that went all the way to the close and pretty much closed on the low of the day, right? So that brings us to today, where we're opening at the previous close and immediately start sliding. Okay, so there could have been an argument to say, well, the market can bounce today. That's fine. That's one scenario. But what have we seen in the past with days after FOMC announcement? When we sell that premium all the way down and close on the lows after the announcement has been made, doesn't that kind of set the stage for what may happen the next day and the following days after that? So we've got this dynamic of, if there's going to be a rally in September, generally, historically speaking, it happens in the last week. So that's next week. It's a full week. And that's, but potentially we could see a rally. So that's the seasonal forces. But if we're going to follow what the market's telling us with this Fed meeting and following through today, there are sellers present. So I would conjecture that the global risk reduction, is not over, that the deleveraging is not over, that people are following the Fed, which means that it's still a hawkish environment, even though people love to speculate like we did on Monday and a bit on Wednesday before the meeting. We saw that bit of a rally. That's this hopeful optimism that keeps creeping up. But as a trader, that gets you into a lot of trouble. The cynical approach is better, not the stubborn. I'm not talking a stubborn approach against the trend, meaning that, oh, well, it's rallying, therefore it's got to go back down, so I'm going to sell it, and then I sell more because now I'm losing money. Now I sell more because I'm losing money. I'm not talking about a stubborn approach. I'm talking about just a healthy dose of this global situation that we're in is not going to resolve itself like that. Think of it kind of like this. Russia went into the Ukraine on February 24th. And people at the helm of that may have thought it would be a quick situation of, it should be done, wrapped up in a month or so. Here we are many, many months later, and it's still going on, and kind of in some ways getting worse, because now we've got more banter about the unconventional weapons, right? So when you look at that, you go, yeah, like things often take longer than you expect. So I want a healthy dose of that cynicism, and again, not stubbornness. So this is where we're at here with the IWM. It's weak. There are sellers. You can see some technical trading going on. Again, as soon as we broke down, you've got information that, hey, it's not bouncing. If you do put trades in for the open, you get that sort of instant gratification of the feedback loop, right? You get information in terms of what's happening. And you can see that we just started sliding, and that should be a big tell for you. So if you were hedged at the open, meaning that you were completely balanced, you did your longs, you did your shorts, even, we were opening at the previous close. So you would say like, well, that's a great discount. No, it's probably an opportunity to be hedged. But now that you get that feedback loop, you're getting information, can you respond to it? So let's go to the top 20 list. I want to point out something here.
Okay.
So these are all curated for having good odds for the day. Now, some of these gapped up at the open. Some stocks that had really good odds for the day actually gapped up at the open, and now they're pulling back. So that's always a bit of an issue, is like, if you got a flat open, do you really want to pay up for stocks? So just keep that in mind, that sometimes limit orders are, the key. But our beta on the whole list is 1.72 average. So we're making comments before that when you have a bearish environment, when you have a risk off approach, that means deleveraging and sellers are there on all the rallies, you want to shift to more of a beta balanced position on your hedges, because if you're just dollar for dollar, generally the stock's volatility is going to be greater than that of the index or the tracking stock to the index, right? Because that would be statistically muted. It has 2,000 stocks in it versus the small portfolio that you're looking at. So even though you have good prospects for the day on these stocks, some of them gapped up at the open, which presents a certain element of risk. Others are just impacted by the general state of the union, the general selling. It's like becomes a market of one to some degree, but the volatilities are greater than that of the tracking stock. So that's why the emphasis on, as soon as you get information from this feedback loop of what you did at the open and what's coming back and what you're experiencing, is you can quickly with one click move towards beta hedging rather than dollar for dollar. Now, what does that translate into? So you can see that the portfolio is down $450, but if you're beta adjusted, it's up, you're up $67. So that beta implication changed the outcome tremendously. And yesterday, for example, the beta difference was around $300 between, if you were dollar for dollar, you would have been, just pretty close to break even. But if you were beta adjusted, you would have been up $300. That's the kind of difference it can make. And so remember, if you have long ideas and you have a hedging instrument, you can trade around your core position on that hedging instrument. And that includes increasing the weight towards a beta situation when the market's weak. Now, when the market's strong and there's a risk on appetite, you don't want to expose yourself to that, because sometimes on those types of days, if you have a diversified basket of a bunch of sectors, the ETF itself could outpace that diversified basket. So if you concentrate too much capital or move towards the beta weighted side on risk on days, then it works a bit against you. So I'm just trying to, kind of educate on the use of hedging. It's not always in your best interest to be exactly $1 long to $1 short. There's volatility implications, there's beta implications, there's risk on versus risk off implications. And all of this goes into, your journey of maturing as a trader, being able to balance different concepts in your mind at the same time, right? And having that emotional intelligence to respond properly to information without, doing weird things. just, stay organized. And when you get the opportunity to, move to a beta hedge, then take the steps. You can do it incrementally, or you can do it with one click and cover it completely. But, that's a, significant difference over time. This is part of you as a trader improving over a benchmark, a baseline, and you yourself getting some extra alpha by your activity. Okay. So general theme is very concerned about the deleveraging that's still yet to come globally, and selling the rallies is probably part of that. And, still allowing for the possibility of a rally next week, because we've seen those movies before, even in bear markets. And if there is going to be a rally, it generally comes at the end of September. Now, we did have one, earlier this month, for 3 days. We lifted off and it did pretty well, but then it gave it back, of course, as September goes generally. Okay.
All right, we're just vacillating here in the 3780 handle. That pre-market low is still being defended. Little difference there, 66.75 versus 72, but these rallies just aren't sticking. So we'll see if we can get back above mid-range on the session. That would be a good point. And your high today, your intraday high, your high since the opening bell, just above the close at 06 1/4. That was 06.75. So bears still on the prowl today. This has been pre-market prep with Stock Odds. Please like the video, subscribe to the channel, and come back at 3:30 p.m. Eastern time. I will be on with Michael Pachter from Wedbush Securities. He is an analyst out there. We all know him. So come if you want to learn some tickers, talk about his Netflix, which has been a strong stock lately. That will be at 3:30. Once again, thanks for joining me. Everyone have a great day.